In this video, I'm going to explain the new Australian income tax rates for financial year 2025 and how it will save thousands in tax for everyday Aussies like you and me. Let's get straight into it. So if you didn't know, Australia operates on a progressive tax system where the more you earn, the more tax you pay. This is the FY24 tax rate, which is applicable from the 1st of July 2023 to the 30th of June 2024. So if you're completing your tax return for the 2024 financial year, these rates will apply. The Australian government has made some tax cuts to these individual income tax rates and thresholds to help many Australians struggling with the increase in the cost of living. Here is the new confirmed FY25 tax rate, which takes effect from the 1st of July 2024 until 30th of June 2025. As you may have already noticed, it has both increases and reductions in the right places that will provide immediate benefits to many tax-paying Australians. This means from the 1st of July 2024, you will pay less tax on your payslip and keep more of your earnings. It also enables you to work more hours if you want without significantly increasing your tax. So let's have a look at the changes. The first bracket remains the same. No tax for income less than $18,200. The second bracket sees a 3% reduction in the tax rate from 19% to 16%. This applies to earnings between $18,201 and $45,000. The third bracket, where the median Australian salary falls, has a reduced tax rate of 2.5% and an increased threshold. Previously, a 32.5% tax was applied to amounts between $45,001 and $120,000. Now the new rate is 30% and the threshold has increased to $135,000. The fourth bracket maintains the 37% tax rate, but the threshold has increased from $180,000 to $190,000. This is a $10,000 increase from the previous year, allowing high income earners to keep a bit more. Lastly, the fifth bracket keeps a 45% tax rate, but raises the threshold from $180,000 to $190,000. So once again, high income earners can earn an extra $10,000 without having to pay the higher tax rate. In summary, the new tax rates are good news for all Australians, especially for the middle class who fall into the third bracket. A common misconception about Australia's progressive tax system is that once you reach a higher tax rate, you pay that rate on your entire salary. This leads to the belief that a pay rise should be avoided to prevent moving into a higher tax bracket. In fact, I used to think this when I got my first job as a teenager at Macca's. However, this is not true at all. As we just saw, the Australian tax system consists of 5 tax brackets and thresholds. When you move up a tax bracket, you don't pay the new tax rate on your entire salary. Instead, you only pay the higher tax rate on the portion of your income that falls into the new tax bracket. For example, if you earn $45,000 per year, you'll pay a 16% tax rate on your income between $18,201 and $45,000. If you receive a $10,000 pay rise, increasing your salary to $55,000, you would only pay the higher 30% tax rate on the additional $10,000. This is because only this portion falls into the new tax bracket. I hope this makes sense and alleviates any fears you may have of getting a pay increase. Please note that these tax rates do not include the 2% Medicare levy on your salary. Most Australians are still required to pay the Medicare levy to support our free public health system. However, the threshold for the Medicare levy surcharge will change starting 1st of July 2024. Please note this is the Medicare levy surcharge and not the Medicare levy. A lot of people get these two mixed up. The Medicare levy surcharge is an additional tax on top of the Medicare levy for high income earners. Previously, the threshold was $93,000 for singles and $180,000 for families. From 1st of July 2024, it will increase to $97,000 for singles and $194,000 for families. So you can earn a bit more without being hit with the surcharge. If you earn above these new thresholds, you'll have to pay an additional 1% surcharge or more depending on your income. However, you can avoid the surcharge entirely by getting an appropriate level of private patient hospital cover for yourself or your family. To avoid the surcharge, your coverage must have an excess fee of $750 or less for singles and $1,500 or less for families. This rule is in place to discourage people from choosing health insurance cover with a high excess fee, which will decrease the premium paid. Please remember to consult your health insurance provider to ensure your package allows you to avoid the Medicare levy surcharge. I'll now show you a worked example to illustrate how the new tax rate changes could help you save on taxes. This is our friend Andy. He works as a banker and earned a salary of $100,000 in FY24. Using my favorite magic tax calculator on the Money Smart website, we can calculate his tax for the year. So let's enter $100,000, pick FY24, and here's the breakdown. He pays $0 for the first bracket, he pays a 19% tax for the second bracket, and he pays a 32.5% tax for the third bracket. So his total income tax is $22,967. In addition, a 2% Medicare levy is charged, amounting to $2,000. Please note that this calculator does not include the Medicare levy surcharge, which Andy would ordinarily pay since he earns higher than the threshold. However, Andy has an appropriate level of hospital cover which exempts him from the surcharge. Therefore, the total tax Andy pays, assuming no other income or deductions, results in a take-home income of $75,033. Now let's examine Andy's tax in FY25 under the new tax rates. Let's assume poor Andy does not receive a pay rise and continues to earn $100,000 in FY25. Let's enter $100,000, But now let's change it to FY25. And here's the tax breakdown with the new rates. He pays no tax for the first bracket, he pays the new rate of 16% for the second bracket, and he pays the new rate of 30% for the third bracket. His income tax payable is now $20,788. Again, he is charged a 2% Medicare levy, which is $2,000. He maintains his private hospital cover, so he won't pay any Medicare levy surcharge despite exceeding the threshold. Again, assuming no extra income and deductions, Andy's final take-home income after tax and Medicare levy is $77,212, which is about $2,000 more than the previous year. Therefore, thanks to the new tax rate, Andy saves around $2,000. So who will get what? Here is a table detailing the savings from the revised Stage 3 tax cut, broken down by salary. To understand this table better, we need to understand what's happened. Initially, the Stage 3 tax cut plan was to eliminate the 37% fourth bracket for those earning over $120,000 per year, and decrease the third bracket from 32.5% to 30% for those earning between $45,000 and $200,000. The original plan also kept the 45% fifth bracket for those earning over $200,000. This original plan favored high-income earners significantly. For example, those earning $80K would only save $875, while those earning $200K would save a substantial $9,075. Given this disparity, the government revised the Stage 3 tax cut to create a more level playing field. The revised rates are the ones we previously talked about in this video. Despite the overall cost of the tax cuts package remaining the same, the tax savings are now distributed more broadly. They are now focused on low and middle income taxpayers who previously did not benefit significantly from the tax cuts. These group of taxpayers who have been struggling with the increases in the cost of living and who outnumber high income earners are now the main beneficiaries of the new plan. So who are the winners and losers of these new tax rates? Let's revisit the table to compare the differences between the original and the revised tax plans. If they stuck to the original plan, this is what you would have saved. With the new revised plan, this is what you will actually save. And this is the difference in savings between the two plans. The new plan distributes tax savings more evenly, with significant savings going to low and middle income taxpayers. The average Australian stands to save around $800 under the new plan. Therefore, the winners in this scenario are the low and middle income earners. While I wouldn't say high income earners are the losers, since 1, they already have a high income, and 2, they'll still receive a decent tax cut, it may just be up to 50% less than what the original plan offered. So when will you receive your tax cut? As per this article from the government, which I'll link below, the individual income tax rates and thresholds will change from the 1st of July 2024. This means from the 1st of July, for most taxpayers, you will pay less tax each payday and keep more of what you earn. Some taxpayers will receive their tax cut when a tax return is lodged and processed after the end of the 2025 financial year. You can use the tax calculator that I showed you before, which I'll link down below, to estimate your annual tax cut. By the way, if you're enjoying this video or found it useful, comment the words tax savings down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this awesome community. Also, please consider signing up to my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, and any cool life updates from me. And if you're interested to learn how to maximize your tax return this year, then check out this video on screen where I'll show you some legal ways to pay less tax and save thousands on your tax return this year. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.